$75,000. $300,000. On paper, that looks like a simple math problem. One house costs 4 times more than the other. But the real comparison isn't the sticker price. It's what happens to your bank account every single month for the next 30 years, and what you actually own at the end of it. A tiny home buyer paying cash for a $75,000 build can be completely debt-free from day one. A $300,000 house buyer, at today's mortgage rates, is often looking at a monthly payment north of $2,000, before taxes and insurance are even added in, a payment that, over 30 years, adds up to a number most people never actually calculate before signing. By the end of this video, you're going to see the real, current 2026 numbers side by side. Not just the purchase price, but the monthly payment, the hidden costs, the resale reality, and the one factor that actually determines which of these is the better financial decision for a specific person, because it genuinely isn't the same answer for everyone. Before we get into the full breakdown, hit subscribe now, because I'm going to walk through every layer of this comparison with real 2026 numbers, and the total cost gap by the end of this video is bigger, and in one specific way smaller, than most people expect. Subscribe now, so you don't miss the full math. Let's start with the purchase price itself. Let's ground this in real 2026 data first, because both sides of this comparison have a wider range than a single headline number suggests. On the tiny home side, current cost guides put a professionally built tiny home on wheels at $70,000 to $150,000, with most buyers landing between $80,000 and $130,000. A more modest custom build can come in lower, with national averages for a complete build sitting around $45,000, and cost per square foot running $150 to $450 depending on finish level and whether it's a prefab shell or a fully custom build. Our $75,000 figure sits right in the realistic, achievable range for a solid, well-built tiny home in 2026. Not a stripped-down shell, and not a luxury custom build either. On the traditional house side, the national median home price in 2026 sits right around $400,000, according to current housing data, which actually makes our $300,000 comparison figure the more affordable end of the market rather than the average. That's worth sitting with for a second. The smaller side of this comparison, $300,000, is already below what half of the homes selling in America right now actually cost. So even before we get into monthly payments, the framing of this comparison is already revealing something important. $300,000 isn't an exaggerated, worst-case example of traditional housing costs. It's genuinely on the lower end of what's actually available in today's market. Here's where the comparison actually starts to hit differently, because sticker price and monthly cost are two very different numbers. A $70,000 tiny home, financed over 10 years at 8% interest, a realistic rate for tiny home financing, since most tiny homes don't qualify for standard mortgages and instead use personal loans or RV loans, comes out to roughly $850 to $900 a month. If it's paid in cash, which a meaningful share of tiny home buyers do specifically because the total is low enough to make that realistic, the monthly housing payment is zero. A $300,000 house tells a very different story. Using current 2026 mortgage data, a 30-year fixed rate around 6.75 to 7%. Principal and interest alone on a $300,000 loan lands in the neighborhood of $1,900 to $2,000 a month. And that's before property taxes and homeowners insurance get added through escrow, which current calculators show adding another $500 to $700 a month, depending on your state, pushing many real-world total payments toward $2,500 or more. National mortgage data for 2026 puts the broader average total monthly payment across all home prices somewhere between $2,300 and $2,500 once taxes and insurance are included. So the direct comparison, month to month, isn't 4 times more expensive. Depending on financing terms, it's often closer to 3 times the monthly payment of a financed tiny home, and essentially infinitely more than a cash-purchased one. A genuinely different order of financial commitment, sustained not for a few years, but for the full length of a 30-year mortgage term in most cases. It's also worth putting a finer point on how differently these two payments accumulate over time. A tiny home financed over 10 years at roughly $900 a month total somewhere around $108,000 paid over the full loan term, interest included. A $300,000 house financed over 30 years at 7%. By contrast, results in total payments, principal and interest combined, that can exceed $700,000 by the time the loan is fully paid off, more than double the original purchase price, purely from the mechanics of long-term interest compounding over 3 full decades. That's not a criticism of the mortgage. Spreading a large purchase over 30 years is exactly what makes homeownership accessible to people who couldn't pay up front. But it's a number that rarely gets discussed next to the more commonly cited monthly payment figure, and it matters enormously for understanding the true lifetime cost of each option. This is the single biggest, most consequential difference between these two purchases, and it's not about money at all. It's about appreciation. Traditional homes, historically and consistently, are treated as appreciating assets, property that tends to gain value over time, particularly when attached to land in a location with ongoing demand. That appreciation is a core part of why real estate has functioned as a primary wealth-building tool for American households for generations. Tiny homes function completely differently. Current 2026 cost and investment guides are consistent and direct on this point. Tiny homes typically do not appreciate in value the way traditional real estate does. Multiple sources describe them as depreciating more like a vehicle than a house, especially tiny homes on wheels. The same basic mechanism as a car losing value the moment it leaves the lot, driven by construction methods, materials, and a genuinely smaller, more niche pool of future buyers if you ever decide to sell. That smaller buyer pool matters more than it might initially sound like. Tiny houses remain a niche market in 2026, which means resale isn't just about the structure losing value. It's also about the process of selling taking longer and offering fewer comparable sales to base a fair price on, unlike a traditional 3-bedroom house in a normal neighborhood, which has an enormous, well-established pool of buyers and comparable recent sales to draw from. A seller trying to move a tiny home may find themselves waiting considerably longer for the right buyer, or accepting a lower offer simply because the pool of interested purchasers is so much smaller than it is for conventional housing. This is the honest, unavoidable trade-off at the heart of this entire comparison. The $300,000 house is expensive every single month, but a meaningful portion of that payment is building equity in an asset that, historically, tends to be worth more in the future than it is today. The $75,000 tiny home is dramatically cheaper every month, or free if paid in cash. But the underlying asset itself is more likely to lose value over time than gain it. There is one important exception worth calling out here, because it changes this calculation significantly for a specific group of buyers. A tiny home built as a legally permitted accessory dwelling unit on land you already own behaves completely differently than a tiny home on wheels sitting on rented or leased land. Current data on ADUs specifically shows they typically add $100,000 to $200,000 of appraised value to a property while owner-occupied, and can generate $1,200 to $2,500 a month in rental income if used that way. Because in that scenario, the tiny structure is attached to land that appreciates, and the value gets captured by the property as a whole, even if the small structure itself would depreciate on its own. The weakest version of the tiny home investment case, by contrast, is a home on wheels sitting on land you're leasing rather than own, since in that scenario there's no appreciating asset underneath the depreciating one to offset it. Both sides of this comparison have hidden costs that the sticker price doesn't capture, and it's worth being specific about both. For tiny homes, the most commonly underestimated cost is land. If you don't already own property, national average land costs run around $18,000 to $19,000 per acre. Those smaller, more desirable quarter-acre lots can run $10,000 to $30,000 or more, depending on location. On top of that, utility infrastructure for previously empty land, running water, electrical, and sewage connections, typically costs another $10,000 to $25,000. Add those together, and a genuinely landless $75,000 tiny home purchase can realistically climb by another $20,000 to $50,000 once you account for actually having somewhere legal to put it. For traditional homes, the underestimated costs tend to be ongoing rather than upfront. Property taxes, homeowners insurance, PMI if your down payment is under 20%, and routine maintenance are all costs that compound every single year for as long as you own the home. Costs at a tiny home, by virtue of its dramatically smaller footprint and systems, tend to scale down proportionally. A smaller structure generally means a smaller roof to eventually replace, less square footage to heat and cool, and lower property tax liability if it's assessed at a lower value. Here's the honest answer, because the honest answer isn't. One of these is objectively correct. If your priority is minimizing monthly financial obligation, achieving debt-free housing as fast as possible, and you're comfortable with an asset that likely won't appreciate, a tiny home in the $75,000 range is a genuinely strong financial decision, particularly if you already own land or can place it as a legally permitted ADU rather than a standalone structure on leased ground. If your priority is long-term wealth building through real estate appreciation, and you can comfortably sustain a monthly payment in the $1,000 to $2,500 range for the length of a mortgage, a $300,000 house remains one of the more reliable long-term wealth-building tools available to an individual household, historically speaking, even with a higher monthly burden. And for a specific, growing segment of buyers, the actual best answer is neither option in isolation, but the ADU version of this comparison. Building a tiny home on land you already own, capturing the low-cost, low monthly payment benefit of tiny home construction while still attaching that structure to an appreciating piece of real estate underneath it. So let's bring this back to where we started. $75,000 versus $300,000 was never really a 4 times comparison. It's closer to a 3 times difference in monthly payment, a near total difference in debt exposure if the tiny home is paid in cash, and a complete reversal in which direction the underlying asset's value tends to move over time. There's no universally correct answer here. There's only the right answer for your specific priorities: low monthly cost and fast debt freedom, or long-term appreciation and traditional equity building. What matters is going into that decision with the real, current numbers, instead of just the 2 headline prices sitting side by side. If you want more of these, real financial breakdowns, real 2026 numbers, no exaggeration, subscribe, because the next video takes this same side-by-side approach and applies it to something we haven't covered yet on this channel: renting a tiny home versus renting a traditional apartment, and which one actually saves you more over 5 years. Thanks for watching all the way through. I'll see you in the next one.